All right, guys, I'm Jay. Welcome back to smarthelping.com. We are doing a model on hydroponics. This is going to get pretty intense. There's a lot of logic that goes into this. I had a lot of roadblocks. This was a really tough model to get right, but I believe it's to a great spot. Um, so what I'm going to do with you here today, I'm going to go through each tab, explain how all the assumptions work, and then you'll know how to use this to create your own financial forecast for hydroponics or aeroponics. It's very flexible, so let's get into it. First tab, global control. What you're going to do, define company name up top, the launch year, and note if you change the launch year, make sure you adjust the dates accordingly for the exit, because this will change if you move this up a year or back a year. This will change because it goes for a max of 10 years, but you can stop the forecast at any time. Here we've just set it up for 2024 to December 2033. You can also include a terminal value or not, and if you do, you can determine an exit value, which is just going to be based on a percentage of revenues. You've also got cash sources here, so debt and then any remaining equity is what the model is actually solving for based on all the startup costs and any net burn, capex, all that combined and the timing of that. This tells you the minimum cash you need to keep uh, the company afloat while you're stabilizing. So if I change this, you can see that number goes up for equity requirement. If we have some debt, we need less equity. And then you also have sources for investors and owners, which is on the cap table. That's where you can manually enter that, and that will flow back to here. You've also got some income taxes, capital gains taxes, as well as the sanity checks. This makes sure all the financial statements and monthly cash flow match, which they all should. No matter how you change these assumptions in yellow, these should always be 0. And one of the main things that people find is they'll adjust the launch year and they'll forget to adjust like the date here on the debt schedule. And so that will cause an issue. So make sure you do that. And I suggest using the drop downs. Don't manually enter anything for the dates. Just use the drop downs. It's easier and less room for error. Okay, next up, big tab here, revenue assumptions. All right, so hydroponics is a way to grow crops without soil. It's for farming. Some call it urban farming. You can do it in buildings. There's a lot of benefits to it, so that's why, there's a lot of these popping up for sustainable agriculture. Let's look at the revenue builder here. So we have the ability to scale up to 20 crop types, and they all have their own start month. And I made this so you can actually plan multiple scaling events. For example, let's say you grow, these 6 types and you start it in month N, and then you grow a couple more maybe in month 24, and then a couple more maybe starting in month 36. So each operation you can plan out based on the start month. You can also adjust the energy costs every time you scale out. You might have another set of different energies that uh, different equipment that's going to have different energy costs, which you'll account for. You'll also have different capex for the expansions, which you can also plan out here. Each expansion, the cost, useful life of the equipment and materials you're buying, um, as well as the month of expenditure. And again, here use the drop downs. Don't drag it. Just use the drop downs for these. So it's really dynamic. And running costs here. So running costs you could also scale out, with crews and planning out when different costs start over the whole 10 years. So you can do one location, you can do a bunch of locations. Well, not a bunch, but like 2 or 3, depending on how many crops you're growing at each location, essentially. So it's really good for that. So on this, you define the crop type here. This is going to propagate the rest of the model if you change these. The start month, the square footage allocated. So here we're going to define our yield based on the square footage allocated to each crop type. The average yield per square foot per cycle. For example, if this is lettuce, there's 200 square feet. We yield 4 heads of lettuce per square foot. Then we can do math to figure out and then based on like the maximum capacity, the percentage of max capacity we actually grow, and the amount we actually sell of that for each of these types, we can figure out the units sold. So that's what's driving these inputs here, and revenues based on pricing. Pricing you can adjust over time by crop type with a percentage here as well. And this will show you the starting price, and these are all priced in per units. So when you put in $6 here, this is the price per whatever unit you're calculating in your yield. So this is going to be your units, whatever you're denominating that in, and that's going to be multiplied by the square footage to get your total, and that's multiplied by the price to get your revenue. You could also define the growth cycle, which is going to, so for example, lettuce is 4 weeks, so we can estimate every month there's 0.92 growth cycles. And that means there's a little bit over 1 growth cycle per month. So we can calculate a monthly value based on that. And as soon as this start month hits, the monthly revenue is going to start for that. And so for things that have maybe 20 weeks, like strawberries, or something that has longer, so there's only 0.2 growth cycles per month, we're still calculating the revenue on a monthly basis, but based on the average. And this is because, yes, you might get paid at the end of the cycle, in the middle, up front. It depends on your relationship with the suppliers. But the best way I could figure out to make this, just so you can study the unit economics and have everything on the same timeline and compare apples to apples, is evenly split everything out based on the value of a growth cycle, how many growth cycles there are in a month, and define what essentially the value of a growth cycle denominated in months. So we have everything in terms of the monthly value, which will adjust based on this. So if the growth cycle were for strawberries were say 4, now you can see the monthly value is going to go way up for this one. Longer growth cycle, let's say the growth cycle is like 40 weeks. Well, if 40 weeks and your yield is 10 units per square foot, and you're doing 100 square feet at $6, well, you're only going to be yielding, in this case, 53 units a month on average. And that's $652 based on the math here. So this times 6 is 3,900. If you take your square footage times yield per square foot times this, 6,000 in a given cycle, and we're saying 1 month is 0.11. So there's your 651, which is this. So this is rounded to 652. Ignore this 3,000. I don't know what I was doing there. But that's how the math works. So that's how we're getting 651 in that case. Let's put this back to 20. Okay, so this is how you're configuring these for each of the crops. This is just defining the maximum yearly capacity grown per year. So you might have a maximum. This is the maximum yield, but you might not be growing that. You grow 80% of that in year 1 and 2, and then maybe you get up to 90% or 95. And then of what you actually grow, so this is the maximum possible capacity you can grow. This is saying what you actually do grow. And then this is saying what you actually sell of what is grown. So you're accounting for waste here. So there could be a differential. And that's adjustable for each crop type. And then price change per crop type and the actual price charge per unit for each of the types over time. And this could be negative percentages if you want to see what happens if prices go down or up, or however you want to do it. You've also got the purchasing frequency here, which is going to be huge because this is going to define when your variable costs are purchased. And it's going to be run off the growth cycle. So for example, with strawberries at 20-week growth cycle, this means we're going to buy all the nutrient costs, the packaging, We have tons of variable costs here. Let me go to that. You've got nutrients. Water's not something you purchase over time, but seeds, packaging, pest control or disease control, testing kits, waste disposal, transportation. All of those things are run off the frequency of purchase here, which is run off the growth cycle. And I've done an offset formula, so it calculates the monthly value per growth cycle. Well, I guess we could go to the variable cost now. So this, we're calculating the total cost of a growth cycle for each of these variable costs, and then we're converting that based on the growth cycles per month into a monthly cost. And then we're going to offset that here on our purchases tab for each, and we've aggregated the total for each high level type. So like for nutrients, we've summed up all the variable costs per month for these. And we do it all for everything except for water, because water is just a monthly cost that's not going to be pre-purchased. But nutrients would be, seeds. So we figure out all the costs per month, and then we aggregate that based on, and you can see each of these is offset by the number of months. So for strawberries, you're going 5 months, so you buy 5 months worth at a time. So that gets you a more accurate cash projection than just evenly doing this every month. You can see what the monthly essentially usage is here in each one, but this is when the actual purchases are made, which is just based on the growth cycle length. Now, if you wanted to override this and just say, well, I just want to do the cost each month as what the average cost is each month based on the total, you could just simply go into your revenue assumptions and put 1 in for each of these. And then what would happen is these costs that are happening every month on average based on the growth cycle and the total cost per growth cycle would just pop in every month. If you want to think about it that way, you could just put 1 in for everything, but this is a little bit more accurate way to track the purchase requirements for cash flow. So variable costs, you got nutrient cost per cycle, gallons per water per cycle, cost per gallon, total monthly cost of that, seed plantlet cost per cycle, packaging, pest control, testing kits, waste disposal, and transportation. And then we're just converting all that based on the cost and the cycle times the cycles per month to get a monthly cost. You can also increase your expenses on average, whatever percent per year to account for that, and that will apply to all of these. There's also your growing medium, so this is like perlite potentially. If you're growing things in some type of material, you're gonna have to purchase that, and it has some useful life here. We're just saying it's 75 cents a square foot. There's useful life of 2.5 years, and then we have an active square footage calculation that calculates this, because remember, if we're expanding over time, you might not need to have 100% of the square footage. If half of it doesn't start for 2 or 3 years, you don't need to buy that perlite immediately. You can buy it as it becomes active or required. So this calculation down here does all of that dynamically to figure out how much active square foot there actually is, and then based on that we can get a calculation based on the cost per square foot. We can also adjust this cost will adjust based on this percentage increase here. And then this also will be depreciable because it's something that has a useful life that's longer than a year, that's directly related to producing the product. So this is going to be depreciation expense with useful life, depending on what you enter here. Okay, next up we have energy costs. So this is all the different types of things you need to grow your crops, and when the start month is, the power rating, the count, running hours per day, total watts used per day, and then converting that to kilowatts per day, and then energy cost per day here. And then we have a percentage increase for energy costs over time as well to account for that. Next up we have, so it's energy, we went over these M1, M2 purchases, running costs, cap table here, you can define where you're getting the minimum equity that's required. So this is actually an overflow row here, which is going to take any cash that hasn't been accounted for in this minimum requirement and put it here. If you had actual outside investors, maybe 100,000, you would manually enter that here in their percentage. Let's say it's 30%. Then we want to reduce this back down so we equal 100%. So you can do that however many investors you've got, their percentage share, and then you can see the resulting distributions over here and IRR over 10 years. Usually people, just to get an idea, they'll just zero this out, set this at whatever percent, and if there is outside investors, and then you've got owners, they might not be contributing anything, which they don't have to, and then this just defaults to the minimum equity required. But you can configure this in a lot of different ways, just depending on how you're doing it and what kind of deal structure you have for your startup. CapEx, we kind of went over this. You can plug in your cost basis for any CapEx items, the useful life, and again, put 39 for that. And then the month you actually expend these CapEx purchases or when you buy them. And you can adjust that each year, and again, use the drop downs. Okay, terminal value. This is just a percentage to define how much of the exit value is going to be applied to any of these CapEx items, except for the first row, which the first row you can manually define the value at sale for if it's a building. But all these other items are dynamic based on whatever useful life is left, if there is any. And in this case, I just put 100% going to extraordinary income, so we're not applying anything to CapEx, and then this is just going to affect taxes. Now let's say I put 95% here, and let's say these were purchased later. $2026. There we go. So now there's still useful life left when it's sold, so we're calculating some value at sale based on what, and this will just prorate the value based on the total we're putting here, which is going to be the reciprocal of this percentage. So if we're saying 5% of this is 2.2 million is going to CapEx, and that is going to apply here. Now, if there were a couple more items, you see how that'll adjust now. Now it's prorated again between the two based on the value or the book value left. So the percentage of book value of each one relative to the other ones multiplied by that amount is how much goes to each one. And if they're fully depreciated, you just want to put in 100% here by the time the exit happens. Startup costs, any other one-time fees or consultant fees, legal fees that you haven't accounted for elsewhere can go into this spot. Debt schedule, you can just enter your loan term, interest rate, payments per year, and the first payment date. Then we have our output report. So we've got income statement. You can see your crop sales, all your different variable costs. Note in this case, we are putting our growing medium cost down here in depreciation expense. But you've got the rest of these other variable costs, electricity, transportation, waste disposal, all these aggregated here. Gross profit, your fixed costs, any other one-time startup costs, total OPEX, EBITDA, interest rate, or interest expense, depreciation expense, taxable income, taxes, and net income. And you see here we account for the sale as well, and the taxes on that will populate for that given month, whatever it might be. The annual detail, same deal, but on an annual basis. You see the whole operational financial line items. Balance sheet, we've got cash and inventory. And you see we're solving for zero cash cash required or cash position. Again, that's the minimum equity we need to keep cash above zero at all times throughout the whole model. So you see we never go back to zero or below it. Inventory, your fixed assets, accumulated depreciation, total assets, long-term liabilities, stock, equity, retained earnings, and then liabilities plus owner's equity has to always equal your assets. That is checked here. And we've got that on a monthly basis all the way through. Got your balance sheet annual, same data but on an annual basis. And your cash flow statement, this is kind of like your sources and uses. You can see what's going on each period. CapEx, how you're funding that with long-term debt, equity, and then the other operational activities that are happening in each period. And then that monthly change in cash flow. Cash flow statement annual, same deal but on an annual basis. We have some visuals here. 10-year revenue, gross profit, EBITDA, units sold by crop type, 10-year expense summary, which is just your variable cost versus your fixed costs, annual revenue by crop type, monthly cash flow, cumulative cash flow, gross profit per year, gross profit margin, EBITDA per year, and annual cash flow. So some nice summary charts. Distributions, this is where we can see at a high level how the IRR of the project went. And you can plug in a discount rate here, whatever you want, and this will update the net present value. This is assuming all of that equity is required up front, and then we use that over time as there's negative cash flows as needed. And this is the total net distribution. So if you do this whole row, this is going to be equal to the total cumulative cash position of the project at the end. So this is 16.48. You can see if we go to the monthly detail at the very bottom, this is also 16.48 at the end. So this is the total effect of all cash flow. And then we've put it into summaries here for the project. Also for the investor view, this is an aggregate of all outside investors. This is an aggregate of all inside investors or owners and their cash distributions and contributions, if any, up front, and the IRR as well as net present value. You can plug in the discount rate for each of those as well, and that will all update accordingly. The executive summary, this is where you're going to see a high level view of all items, revenues, costs, EBITDA, and then all other cash flow items, and then final cash flow post-tax. So this is a really good snapshot of the project and to see what is going on, what are your expenses looking like, what are you spending on CapEx, what is your debt service over time, selling proceeds, and as well as project and investor / owner IRRs, total investment required, returned, equity multiple, and total ROI over the whole project. Okay, monthly detail. Here you've got revenue by crop type. You've got variable costs. We've got total variable cost, gross profit. So this is going to show you all of the different assumptions, how they're coming together on a monthly basis. Your fixed costs, EBITDA, debt service, other cash flow items. And you can group these if you don't want to see all the totals. You can just group them up there, and now I can see everything at a high summary level. Annual detail does the same thing, but on an annual basis. And if I wanted to group it, I just hit the little number 1 over here. And that's the whole model. So this is available for purchase. I'm only charging $45 one-time fee for it. If you want to purchase it, you can go on over to smarthelping.com. It's going to be listed in the, well, let me show you here. So we're going to list it in the industry specific general industries tab. Down a couple sections, it'll be in the food industry. I know it's like agriculture, but I'm going to put it in with the apple orchard, the food truck, and the franchisor model. It'll be categorized into that as a subcategory, and then the larger bundle it's going to be included in is the industry specific bundle, which again you can buy everything I've ever built in this bundle for $2.99. There's a whole bunch of financial models here for all kinds of different industries. And remember, if you want to buy more, you can check out everything at the Financial Models tab at the top. I've done a whole bunch of SaaS models, real estate modeling. You saw the industry specific stuff, joint ventures, business valuation, accounting templates, HR tools, Google Sheets, sales pipeline, and all kinds of different things. And you can buy everything on the whole site if you click the Learn More here at the link at the top of the Financial Models tab. And you could actually buy everything for $9.99, and that includes over 150 templates. Tons of value here if you're in finance or looking at different businesses you want to start up and just trying to see how the logic is structured and test different feasibilities and use bottom-up assumptions that are specific for different businesses. Alrighty, well, that's all I got for you today. Like and subscribe, and I'll see you guys on the next one. Oh, and remember, I do custom work as well. I do custom financial modeling, so this is a one-size-fits-most situation with these templates. If you need custom work, that's completely fine, and everyone likes to do their own little style for how their certain situation might work, and I do. I'll update something for you, implement logic for a model you purchased, or build something from scratch. And you can see on average, here's my job costs over time since July of 2017. The little scatter plot showing the average or the hours and the cost of each job I've ever done through Smart Helping, and a bell curve showing you essentially the likelihood that a job is going to take 1 to n hours and build from 0 to n cost. And you see the average here is around 400 bucks. That's basically what my average is for a given job in about 4 or 5 hours. Alrighty, see you guys later.